to create a resilient all-weather portfolio but don't know where to start, I think I might be able to point you in the right direction. On the other hand, you have no life because you're sitting there in front of spreadsheets, analyzing, reanalyzing, and trying to find that perfect needle in a haystack. I think I can help you as well. Do you have no life, not because you're doing these things, but you just generally don't? Well, I can't help you. Go adopt a dog like everybody else. So you've probably considered actively managing your own portfolio, picking a couple of stocks that you think are about to go hyperbolic and 20x and all that sort of stuff, right? So imagine you put together an actively managed portfolio of your own design with just 3 stocks. One of those tanks, you're down 33% on your portfolio for the year, and that's really, really hard to recover from. The other option is to buy into an actively managed fund, and I'll give you a little anecdote. For years, the Wall Street Journal ran this competition where they sized up active managers against literally a chimpanzee throwing darts at a dartboard picking stocks. And if you're guessing that the chimpanzee won, you'd be right, but it's even worse than that. The chimpanzee won consistently. So instead of trying to pick winners and losers and mostly picking losers, I've instead put together a portfolio I like to call the 3-fund lazy portfolio. And yes, it actually consists of just 3 funds that you can buy and hold pretty much forever. It's a really simple investment strategy for a beginner, and it's really, really low maintenance. So the goal of this video is to introduce you how I use the 3-fund portfolio, or the Boglehead portfolio, sometimes it's called, to manage my own portfolio, and to get you started on thinking about why you would want the 3-fund lazy portfolio, what to put in it, and I'll tell you exactly what I put in it, deciding what proportions to use in that portfolio for each of the 3 funds. And then finally, I want to share with you an application that will allow you right now to look at different proportional spreads and try to evaluate what's right for you and your risk profile. I am not a financial advisor. I don't pretend to be. I'm just going to share with you guys how I manage my own portfolio and hopefully get you started on something that is really simple if you need that. Okay, good? Let's get going. So why would you want the 3-fund lazy portfolio? Well, to understand that, let's talk about what's in it. First, we have to understand index ETFs, or exchange traded funds. These are funds that are designed to essentially index either a total stock market or a portion of it, just the energy sector, just healthcare, just tech, or maybe everything in the US or everything in the world. Vanguard provides a variety of these index funds, and for our purposes and my own purposes, I actually use 3 index funds in my 3-fund lazy portfolio. One of them is designed to mirror the US stock market, the total US stock market. It's weighted by market cap, so it is automatically a little bit less risky than, say, going into smaller mid caps. The second one indexes the total world stock market, so everything outside the US. And the third indexes the total bond market. Let me share with you what those 3 funds are right over here. So VTI indexes the US stock market, VSUX indexes the world stock market, and BND, as its name implies, indexes the total bond market. That's it. 3 funds, all of the diversification you need. None of these overlap. So why is this 3-fund lazy portfolio so great? Well, there's a number of reasons. Just to quickly review, diversification is built in, not only amongst US, world markets, and then bond markets, but also in terms of large, mid cap, and small caps as well. It's fairly cost efficient. They're also super tax efficient. Because these funds are indexes, they're not constantly trading. And the problem is when you have an active fund manager that's constantly trading, those are short-term profits whenever they do acquire them, which means that all of the tax implications then funnel back to the index fund holders. There's no manager risk. If your manager, for whatever reason, decides to quit an active fund, there's always the risk of the replacement manager not performing as well as the last manager. Finally, there's no overlap. There's no front runners because it's an index. It's a super easy rebalance. I do it semi-annually, but you can do it quarterly or annually if you're truly, truly lazy. And it is, by definition, simple and ultimately lazy. Now, the next question becomes, what proportions should you buy all of these funds in? Should you follow a 60-40 split where 60% of your portfolio is stock funds and 40% is bonds, or a more aggressive 80-20? So as promised earlier, let me show you a really neat tool where you can start to look at the proportions that are right for you. And I want to stress that I can't tell you what the right proportions are for you. So if you're earlier in life, say in your 20s or even your early 30s, a more aggressive mix is probably what your financial advisor will advise you to do. That is, weight the proportions heavily towards equities and less heavily over bonds, which tend to be more stable over time. On the flip side, if you're close to retirement, you probably want to weight heavily in favor of bonds. So again, do your own research, talk to your financial advisor. But as promised, let's show you a little application here that will help you look at sample proportions so that you can make the right decision. I suggest using portfoliovisualizer.com. Super simple to use. What you're able to do is to report on year-to-year returns. You can set your start year. Here, let's set the start year to, let's say, the year 2000. So we're looking at a 23-year spread. I'm currently recording this in early 2023. We can start with any initial amount, let's say 10,000, and then we can start to input our funds right down here. So I've put in VTI, the US Total Stock Index ETF, the International Stock Index ETF, and then the Bond Index ETF. And then just for kicks, I've created a third portfolio, which follows pretty similar macros to Portfolio 2, but just for giggles, I've actually taken a little bit out and included holding Bitcoin, just to show those of you who are interested in crypto assets what this would look like for your portfolio. Pretty straightforward. Just make sure everything levels out to 100%. You can try different combinations. So you'll see if we click Analyze Portfolios, it actually will take us down to the composition of each portfolio and actually show us what a performance summary will look like. Here's your initial balance. Here's your final balance. For those of you who are interested in looking at what the breakdowns look like, you can see your compounded annual growth rate, a little bit more conservative with the 60% stock, 40% bonds portfolio, a little bit better with Portfolio 2. And what was interesting to me is if we threw in just 2% of Bitcoin, remember Bitcoin and crypto completely crashes, you may lose a maximum of about 2% of your portfolio, so you recover. But what's interesting about this is your worst year isn't that much worse and your best year is just a little bit better. So for those of you looking for aggressive portfolios, I have zeroed out all of these ticker symbols, and you'll notice here that if I click on the little gear, I'll have the ability to select a wide variety of what are called lazy portfolios here. For the record, one of the things that you'll be able to find here is the Bogleheads 3-fund portfolio, and that's basically my 3-flip portfolio by another name. You'll also see, some other portfolios here, David Swenson, Harry Brown, and so on. The Ray Dalio All Seasons portfolio is kind of an interesting one. It's got some gold in there and some other interesting things as well. So you can take a look at this and just kind of browse through and sort of take a look at all of the different portfolio setups, and that will help you as an educational guide as to what might be the right portfolio for your current stage in your life cycle as well as your risk tolerance. So hopefully you find Portfolio Analyzer to be helpful in determining what portfolio works well for you. So if you love this video, sub. If you liked it, like. See you next time, and you're welcome.